Right, we want to bring in Amy Kong, Chief Investment Officer at CI Barrett Private Wealth. Amy, it's good to see you. So before we get into some of the other news of the day, just first, your reaction to this St. Louis Fed President Jim Bullard retiring here from the St. Louis Fed. He's been president there for 15 years, a hawk. How is the market, how should investors be viewing this?
Yeah, I think the fact that he does carry a more hawkish tone and stepping down, the markets may be perhaps receptive to that from the standpoint of the markets being up today. Of course, there's PPI numbers also boosting the story today. But I think overall, it doesn't necessarily change what expectations are for interest rates for July or maybe even for the rest of this year.
So, Amy, one follow-up question I want to ask you. So, sure, it may not change things for the rest of this year. We know the St. Louis Fed hasn't been a voting member recently, but within the next couple of years, they will be. Do you think that that will change the expectations going forward about what could happen? I mean, certainly if there's a more hawkish person instilled in the role, that could certainly change the direction of what we expect to happen.
Yeah, it's a great point, Diane. I think, it's depending on how, hawkish or dovish that next person is, markets may react in the very short run. But as I've mentioned in past, sessions, I think ultimately the Fed will be very data dependent. And right now the data is suggesting that perhaps one at the very least in terms of rate hikes could hopefully help seal the deal. But again, it's all very data dependent. And I think at this junction, as you've noted, Seana, the market is fully expecting a rate hike for July. And what happens after that will obviously depend on jobs numbers as well as CPI and PPI numbers, PCE numbers along the way.
Yeah, Amy, how are you looking at the inflation data that we've gotten out this week? Because once again, we've gotten two data points out. Producer prices this morning, CPI yesterday, pointing to the fact that inflation is continuing to cool. Just what that signals just in terms of future improvement, because now with CPI at just about 3%, the question is what needs to happen to get it down to 2%? What is that next move? What does that look like here over the next several months?
Sure. What we're seeing is a basing effect, right? So essentially very high numbers from a year ago are dropping off. And so that cooling effect is certainly taking place, and that's welcomed. I think what's obviously been holding up inflation is just wage inflation and just the jobs market still being very strong, or at least stronger than expected. And that's something we're very keen on watching quite closely, because as that starts to roll over and we are starting to see cracks in the system, that will obviously be a headwind to a degree towards how consumers will spend and how sticky inflation continues to be.
Given where CPI and PPI came in, do you consider inflation still sticky at this level?
I do. I think ultimately we're looking at core inflation, which has not been moderating as quickly. And, again, when we think about what folks are spending on, the services side to the equation continues to be very strong. And I think, again, because wage inflation is still 4% plus or minus, that continues to be an anchor in terms of how people feel about the economy and willingness to spend.
Amy, how are we squaring this, or how are you squaring this with what's happening in the labor market? Because we are seeing other parts of the economy slow. Yes, we have seen job growth slow a bit, but it's still very, very strong. Once again, above 200,000. Claims also relatively small here in the scheme of things. When are we going to start to see more job losses, or do we need to see significant job losses in order to see that cooling in inflation?
I think you're right. The data has certainly been conflicting, right? And the jobs market continues to come in stronger than expected. Just take a look at the ADP number from last Thursday. It really blew the charts out. So ultimately, what we're thinking is, as long as that number continues to be positive, again, that conflicting data point continues to kind of make economists scratch their heads in terms of how is this going to all pan out. And as long as wage inflation continues at that 4% plus or minus, as I've mentioned, I don't necessarily think inflation will cool off as quickly as investors are hoping for. We are seeing cracks in the system, though. Again, cracks just mean red flags or just signals to watch for. They're not quite wide enough to suggest a recession next quarter, but I think those cracks in the system would be foolish for investors to ignore those cracks.
What are the cracks that you're the most concerned about, Amy?
Sure. So some of the cracks that we're seeing just include typical signals that tend to happen before a recession, including the fact that temp workers or the hiring of temp workers are waning. I think the unemployment rate for certain cohorts are starting to pick up a little bit. And that, again, from a historical standpoint, tends to be the first signs that the jobs market is cooling off. Mind you, the jobs market is also a lagging indicator. And so we are very much paying attention to leading indicators, which will include sentiment, ability or willingness to invest in capex, the growth rate of the money supply. All of those as a collective has actually peaked, in our opinion, in May of last year. And typically history suggests that if it peaks, maybe 12 to 18 months, maybe 24 months out, you start to see, again, the economy rolling over. It's also interesting to note that over the past 50 years, there hasn't been a recession where the yield curve hasn't inverted. And so that's another signal that we're watching quite carefully as we think about whether a recession might materialize.
Well, Amy, investors also very closely watching what's going on with earnings. And earnings season is now officially here. We got two big reports before the bell today, Delta and PepsiCo. When it comes to Delta, they delivered a huge beat, and they also hiked their full year outlook on record quarterly earnings. CEO Ed Bastian expecting the consumer to stay strong, forecasting a jump in revenue of as much as 14% on the year. And then PepsiCo brushing off any signs of a consumer slowdown, at least for now. The company behind brands like Doritos and Lay's chips, they beat the street's expectations and now see 10% organic revenue growth in 2023. Amy, we know the bar has been set very low for earnings season this time around, but beats like we saw from Delta and from PepsiCo, is that enough for this market's momentum to stay intact?
Yeah, I think, in the case of Delta, we would expect good numbers from them. Only because the international travel component continues to be very strong, and Delta, United, a lot of these national carriers should benefit. PepsiCo posted very good numbers, and we obviously welcome that. But we are starting to wonder how much more pricing can they pass through to the consumer. And volume continues to be a question mark for them, because ultimately you need both components to really, again, drive earnings forward. And while pricing has been a welcome sign, again, we do question as the consumer starts to lose steam a little bit, right? Excess savings starts to come down, wage inflation also moderating. How much more pricing can that take place? And that's something we're going to watch pretty carefully across the board, not just with the consumer stocks, but across multiple industries in terms of how much pricing power is still left.
So, Amy, I want to ask you, so what kind of tone does this set for the rest of earnings season, particularly when you think, I know we're just at the very beginning, when you think of the consumer-facing companies?
Sure. I think the bar is set low. I think to Seana's point, year over year, I believe expectations are down about 7% from last year's second quarter to this year. And I think the energy component will likely be softer. We are going to see the banks report. I think the consumer, again, depending on what sub-industry, they're likely to hold up because we are still seeing some excess savings. Wage inflation, as I've mentioned multiple times, continues to be still trending positive. And as we think about the earnings season for retailers, it's really going to depend, right? Goods manufacturing or goods retailers might be a little bit softer versus services. And so we're going to be watching those components quite carefully.
Amy, what does all this mean for investors' portfolio positions, just in terms of what you see leading this next leg if we do end up higher from here?
Yeah, we are cautious as we think about client portfolios and their positioning towards stocks. As an investor, you never really say no to a rally like the ones we've been seeing since, beginning of this year. But we are a little bit uncomfortable in terms of how we've gotten there, because really it's been multiple expansion. And the fact that we do expect earnings to soften for this quarter as well for the remainder of the year, it kind of gives us a little bit of cautiousness here in terms of how can the market sustain a 20 plus price to earnings multiple. And so as we're thinking about client portfolios, we are mindful of that. At the end of the day, we're still looking for quality. You've got to understand what you are owning in this kind of environment. Pricing power continues to showcase itself across certain companies and industries. But again, we're questioning how much further room there is. And at the end of the day, I think investors, just given the regional bank meltdown and such, are looking for quality balance sheets. And so that's, again, top of mind for us as we kind of digest through the next couple of weeks of earnings.
Amy, let's talk about one big play, AI. So it seems the generative AI hype isn't slowing down anytime soon. Investors have poured money into AI stocks this year. Market leader NVIDIA, that stock up 208% since the start of January. So, Amy, some investors cannot afford NVIDIA where it is now. So what opportunities should they be playing in if not NVIDIA?
Sure. We like the mega trend, right? AI as a mega trend, we think can be applied across multiple industries. But, realistically, the execution of AI will hit some bumps along the way. There could be regulation talks. There could be just the idea that, perhaps the information that these bots spit out could have some flaws in it. And so, again, the steam or the momentum, if you would, could die down. Ultimately, NVIDIA is a pure play, but we try to play the AI theme through multiple channels. I think hyperscale cloud infrastructure is one way of doing it. That would be including companies like the Amazons and the Microsofts of the world. Microsoft, of course, is also got the opportunity to invest directly in AI Open, which obviously is the maker of ChatGPT. And then, of course, when we also think about strategic consulting, a lot of companies are thinking about how do you implement AI? And I think companies like Accenture could be another interesting way of playing it, again, because of their positioning within the strategic spectrum.
Amy, how are investors or how are you approaching earnings season this time around when it comes to AI? Because over the last 2 quarters, we have certainly seen a lot of hype, even if a company just mentions AI and its plans here for the future. But are investors going to be holding some of these firms, I guess, accountable just to start showing how it's actually improving their business?
I think you're absolutely right. And that's likely to take place in the coming quarters. Certainly when you have a big mega trend like this erupt, a lot of the initial buzz is just momentum, right? Everyone just wants to get into anything that mentions the word AI. But I think ultimately that starts to cool off, that starts to moderate a little bit, and investors will start to question, okay, now that the tide has lifted all boats, let's figure out which of the companies can actually make money off of AI. And that's what we're very focused on. We're also focused on valuation. So we're really trying to balance out, let's cut out some of that momentum and think through PEG ratios and such so that we are comfortable owning the companies that can actually materialize earnings through this AI megatrend. And so I think ultimately you will start to see some of that moderate if companies can't deliver on what they've promised on the AI spectrum.
Amy Kong, CI Barrett, Private Wealth Chief Investment Officer. We appreciate your deep dive from Fed to AI, whether it's friend or foe. Thank you, Amy.